there are some that are like Bitcoin companies, the type of companies that, like our fund invests in, that they need Bitcoin liquidity for a lot of different things. So if you already have a business related to that, we know that some of the treasury companies are like thinking about, how do we, buy a Bitcoin business that'll be beneficial to our Bitcoin stack. And you can use your Bitcoin to supply liquidity to the company and ultimately earn more profits and have a cheaper source of liquidity for the company because you own it. So there's a synergy that you get from having an operating model that needs Bitcoin and then owning a large Bitcoin treasury. So that's another way to differentiate. And then I guess one last point I'll actually make on the operating model. It's a really challenging question right now because every dollar that you have that you're putting into a business, that gives you that synergy is a dollar that also could have just gone into Bitcoin. So your opportunity cost of capital on owning that operating model is what the capital appreciation of Bitcoin would have been otherwise. And so people are going to have to justify, okay, we want to own this business, and the synergies we unlock from owning this business with our Bitcoin stack is more valuable to us than just owning Bitcoin itself. And that's the most interesting thing to me, because that's what, we're thinking about a lot as a business. And I'm really curious to see what we start to find from some of these companies related to that. And so the third way, and I think that this will be the most common way that these companies differentiate, is by earning some sort of rate of yield on their Bitcoin directly. And not every Bitcoin treasury company is going to become an asset manager, because that's what you're doing. You're managing an asset, you're earning a rate of interest on it. And there's ways that you can do that natively with Bitcoin that you can't really do in other areas of finance. And that's because they're specifically related to technologies that Bitcoin interacts with. And Nick Bhatia kind of theorized back in, I think, about 2018, this idea of a term structure of interest rates that's distinct for Bitcoin. And we have this like new native capital market. If we believe Bitcoin is the foundational money for the world, in the same way that the US dollar has a term structure of interest rates, Bitcoin has its own term structure of interest rates. And what I mean when we say term structure of interest rates is just there are foundational interest rates that we look at for the US dollar today. And people have, commonly heard of the risk-free rate, and that's your shortest duration US government debt. And that's at like the bottom of the curve. That's at the beginning of the curve. And we say that's the quote unquote risk-free rate, which we all know is bullshit. And all that risk is happening through inflation to us. Every time, the government's printing money to pay for money, it's effectively going bankrupt, and we pay for it through inflation. That's what risk-free rate means. And then when you move up the yield curve, there's other forms of longer duration government debt on this term structure of interest rates. And those have higher risk because they're longer out, and you know what the expectations are, et cetera. So we have something similar that's emerged on Bitcoin, where at the bottom of our term structure of interest rates on our like Bitcoin native yield curve, we have things like, at the bottom, it's like self-custody. You don't have anything. That's like the closest you can get to risk-free, and that's still not perfectly risk-free. You can lose your Bitcoin in self-custody. But then you could put it into something like earning routing fees on the Lightning Network. And just by like committing some Bitcoin to earn routing fees, you can get a capital return on your Bitcoin in the Lightning Network. You can take a little bit more risk, and you can start liquidity leasing that Bitcoin into the Lightning Network as well. So there's like two types of fees you can earn from just putting liquidity like Bitcoin into the Lightning Network. These are like very low risks, at least from like a financial standpoint. Operationally, it can get more complex. But those are kind of like more towards the bottom. And then we have things like other things that are emerging. There's another protocol called ARC, and that's going to need liquidity. And then there's going to be fees that people can earn by running an eCash mint. And then there's going to be other things like zero knowledge rollups, and those are going to allow you to stake your Bitcoin into these protocols and earn some sort of inflationary fee on that. So there's all these different ways you can take Bitcoin and earn interest in ways that you can't really do with any sort of traditional asset. And then you can even do it in traditional ways. You can lend Bitcoin, which we suspect the banks are going to be doing. And there's a bunch of other avenues that are like in traditional form, whether it's secured lending or unsecured lending, and et cetera. So that builds us this like yield curve. And all these Bitcoin treasury companies are going to be looking at this yield curve and determining how much risk they want to take on this curve and what type of yield they want to be earning. And to do that in all these Bitcoin native ways is going to be really complex. So what we suspect is that not every treasury company is going to be doing that. Not everybody's going to have the proficiency to do that. There's very few people in the market today that really know how to do that. There isn't like a best practice. Nobody knows what this like optimal way of doing lightning liquidity leasing is yet. We're all just kind of learning. So there's going to be really specialized firms doing this that are like, we can get a much higher interest rate because we know what we're doing technically in this, and we're going to participate in some of these new networks, and we have the technical ability to assess things as they emerge in a new way that you do not. And what does that mean? All these Bitcoin treasury companies are going to start getting their Bitcoin and giving it to these asset managers that are earning them a yield. And then they're going to get their yield. And then they're going to go tell the investors in the treasury company, hey, we got, this return on Bitcoin capital this quarter. And so we suspect that there's probably going to be a decent amount over the next couple of years as that process starts to unfold. We'll see more concentration of the Bitcoin into some of these asset managers and control over it through custodial providers than in the actual Bitcoin treasury companies themselves. And that's going to be kind of like the bank like function that they're ultimately fulfilling. They're taking in Bitcoin from raising capital from their investors, and then they're going to go earn some sort of rate of return on it. But yeah, so that was kind of one of our interesting predictions from some of it.
That is interesting. And there's so much with banking and Bitcoin, because like on the one side, I fully understand like the stable coin side of things. And then also like, I mean, I'm not at any, like, I'm probably not very representative of the normal user. I now, except Bitcoin, I have probably 70% of the income through that podcast completely in Bitcoin. With the business of Microseed, I don't think it's more than 30% that actually comes in with like, because it's B2C, that like how many people like buy directly through Bitcoin, even though we do everything with a Bitcoin provider, but they also like handle the hard card payments and all of that. And then I also try to like pay people in Bitcoin, so like my freelancers and all of that. And I use more and more just like a Bitcoin account, and it was interesting. I was on a I was on a crypto channel as the Bitcoin maxi kind of, and afterwards the guy asked me, "Oh, like how do you handle their finances with people all across the world?" And I was like, "Yeah, Bitcoin." And they're like, "Oh, why don't you use stable coins? Like it's so much better." And I'm like, I don't know. I don't even want to do that. Like, I just want to be with Bitcoin. Like, why would I like change my Bitcoin to stable coins, like change it around, like transact? Like, Bitcoin is super easy. Like, it's just there's an address, like I send it and like receive it. Like I do it even on chain. Like, I don't do anything on Lightning currently because the fees are so low. And if you transact for like, I don't know, like 500 or $1,000, like paying 70 cents for that transaction, like I don't care. It's like nothing. You pay a lot more if you give someone in El Salvador $1,000 over the traditional financial rails from Austria than like 70 cents on the Bitcoin layer. So I'm really curious how you feel like the mean of exchange side of things of Bitcoin will progress. I mean, some of the things we already touched on with the stable coins, but how do you see currently like the mean of exchange side of things for Bitcoin?
So a big part of our thesis is for like our fund is the way that we view it is there's like three primary cycles of Bitcoin adoption. And we view those cycles to be aligned with its adoption for different functions of money, each kind of building on top of one another. So when we think about how money has just been adopted historically, it's not that everybody wakes up one day and says, I'm going to use this form of money now. When money was adopted in private markets, it's something that would naturally progress through different stages and eventually become something that everybody was using as money. And stage number one is it a good store of value? Because without being a good store of value, it's hard for everybody to want to own it in the first place. And that's like a really key ingredient. I think when a lot of people criticize Bitcoin, who are like traditional economists, will say, well, most of the other goods that were used in primitive times, they had some sort of utility. And because they had some sort of consumption utility, a lot of people own them. So in like agricultural societies, when people owned cattle and people owned salt, these were just very common goods that everybody was using all the time. And then they ended up using those two goods as money because everybody had them. Everybody always had a demand for them. And that's kind of the argument against Bitcoin. And what we argue for is that, well, no, it's kind of two factors. What makes people want to own something? And it's kind of two factors that makes people want to own something. It's either its consumption value, which is what we're describing with cattle and salt. People wanted to eat it, people wanted to put salt on the meat, or it's the monetary value, being a good store value. And a lot of people would just own assets because they were just scarce assets. And that's how we saw precious metals get adopted, like gold and silver, is that they were the scarcest commodities in the world at that time. And that made them something everybody wanted to own because we knew the supply of them wouldn't drastically increase. And so that's something that allows money to slowly become something that everybody owns. And that's the phase that we're in with Bitcoin right now, is we're consuming the market of the store value. And that means we're getting everybody to own some Bitcoin. And the second everybody owns Bitcoin, that's when, or at least the vast majority of people, that's when things start to get really easy when it comes to thinking about it as a medium of exchange. Because one, at that point, so many people are going to own it that the volatility has decreased so much. And two, everybody's going to be familiar with it. Everybody's going to know how to transact in it because they own it in some way, shape, or form. And that greases the wheels and reduces all the friction to using Bitcoin as a medium of exchange. So like we're in this S curve market right now trying to capture this whole store value market. And we view that as a longest adoption cycle. The second that happens, the other two cycles will be more rapid. And then that means it's going to be used as a medium of exchange. And people all just start saying, okay, well, all of us own Bitcoin. Um, Bitcoin's kind of how we're saving our money now. And I just pay me in Bitcoin because I want more of that, because this is like my savings payment basically. And pretty much everybody I know also accepts it. So it's really easy for me to just like pay for something else in Bitcoin. And that's when we're in this medium of exchange cycle where, to the point I was making earlier, a lot of the people that are selling things are going to be the ones saying, pay me in Bitcoin, not in dollars, not in whatever else. I want direct Bitcoin because I know its value. And and then while that happens, it's like, okay, well, we're all just starting to pay each other in Bitcoin. Why don't we just start denominating everything in Bitcoin? And that's the final cycle of it consuming the unit of account type market of money, where people actually start accounting for everything and structuring prices in it. And the second that happens is when we get true price stability. Once people are denominating their assets in it as a unit of account, that's when Bitcoin becomes this stable monetary asset. The same way gold was used to price everything at one point in time. Um, so that's kind of how we view the adoption cycles happening. But the store of value phase is still a long ways out. You know, there's arguably a few 100 million people in the world that have some sort of exposure to Bitcoin right now. And it could be a lot less. It's just like a lot of assumptions we're looking at. But there's quite a bit of room in terms of the amount of people that haven't been exposed to the market yet, because even of the people that have exposure, most people have a very small amount of exposure, and a very small amount of people have a large amount of exposure in terms of their personal wealth. So there's so much more to go until like 60-70% of the world owns Bitcoin. And then once that happens is when we're getting a lot closer to like, okay, so now everybody's kind of familiar. It's really easy for people to start trading in it because we all just own a little bit and kind of get it.
Super interesting. Do you have any like kind of like timeline on that? Like anything like how long those like adoption cycle
I think the
usually like?
store value adoption cycle is going to be going for the next 5 to 10 years. And that seems like a pretty reasonable amount of time. If we look at the progression of Bitcoin historically and how rapidly it's grown through adoption, even with diminishing returns, 5 to 10 years is plenty of time for that rate to continue, and then to ultimately capture probably a majority of global population. We'll have to see. It could be, there's a million people with a million predictions about this type of stuff, and nobody knows. Um, but that's kind of how I'm planning for it. Like with us being a venture capital fund, when we're investing in companies, we're looking at companies that are building things that help people use Bitcoin as a store of value today, because we view that as just the most important thing to be building for right now. Like if you're building a company that's designed around Bitcoin being used as a medium of exchange, it's going to be a lot harder for you to find users. And that's, you might be putting the cart before the horse in terms of this is just too early. There's a lot of good ideas out there. And one of the big problems is that a lot of times people are too early with good ideas. It just wasn't the right time in the market. And So like when we think about it in terms of like our fund, we're thinking about it on like a 5 to 10 year time horizon for a lot of the store value adoption happening. And what types of companies are going to benefit from that is companies that allow you to buy Bitcoin, allow you to hold Bitcoin, allow you to take loans out against Bitcoin, allow you to do international payments, all these different types of things.
Super interesting. What is actually, I think I haven't the second podcast, and I haven't really asked you about the venture capital fund. What are you guys doing, and like what are you kind of focusing on? I mean, we had it in the beginning, I think a little bit.
Yeah, like so our big mandate is focusing on Bitcoin adoption. And like we don't think we're like smarter than the market on anything. We're waiting to see what emerges related to all the different opportunities. But like, what's the North Star that we guide ourselves by? Is this company idea, software protocol, is this forwarding Bitcoin adoption in some sort of way? And our thesis is that there's going to be very high return ways of getting exposure to that. So like a really good example of this would be a company that's getting into lending. Um, the value of a lending company where they're earning fees based off of giving people loans, and there's this perennial demand for people that want to take out loans against Bitcoin because they don't want to sell their Bitcoin. They would much rather say, okay, I'll pay a smaller rate of interest in the near term, and then I get to keep my exposure to the upside over the long term. Because Bitcoin's such a high appreciating asset, and because we have a massive global cult following of hodlers, there's a lot of loans that people want to take out against it so they don't have to sell it. So we have this market that's already like, highly attuned towards doing that. And what makes their lending business grow? Well, the value of the asset they're lending against, the collateral, grows. So as the price of Bitcoin goes up, the value of the assets any sort of lending business is dealing with goes up. Its market just starts to grow, grow, grow. And then we also view that the percentage of lending in the market is a lot smaller than what it'll be naturally over the long term. In that banking report I mentioned, we had some numbers to kind of show what that could look like. And so we think also lending is just going to expand more as a percentage of the total amount of Bitcoin that exists. And that market is just very infant right now. So like not only are you growing with Bitcoin, but you're growing with the size of the loan market as well as it grows in proportion to Bitcoin. Um, and then you can earn fees not just from issuing loans, but you can earn fees from the second it gets called. So even during a time when Bitcoin is not performing well, like a lending business is earning a lot of fees from loans getting called in, and then they're getting the collateral too. So like there's businesses like that can do very, very well. And it's our job as like investors to look at these things and make the right decisions, and on a portfolio wide basis, how well can some of these things do? But we're really looking for that. We're like, it's kind of akin to like with a Bitcoin treasury company when they say it's like a high beta version on Bitcoin. It's like we're looking at that, but in financial theory, um, the private companies we're getting exposure to that we're looking at in terms of being like a high beta play on Bitcoin. Um, Another big advantage you have with dealing in private markets versus public, which is like where Bitcoin treasury companies trade, is that in private markets, in financial theory, it's called an illiquidity premium, is one of the things that you're getting compensated for. So because a private market is an equity ownership in some sort of company, but there isn't an exchange to go sell it on, it's not as liquid. There's no liquid market. And the reason for that is that, we have certain standards that a company needs to be this big and it needs to meet these types of, financial metrics and abide by these rules and regulations in order to list on a public stock exchange. Companies that are much earlier or choose to remain private, they don't have those benefits, but they get to do a lot more of what they want to do, and they don't have to abide by these regulations. So in startup land, because it's very early and because they're in private markets, there's a premium that you get because there's a lot more inefficiency happening in the private market. Um, so a lot of the value that you can find, and one of my, basically since I've been in college and I studied finance, was that I always wanted to work in private markets because that's where the majority of the inefficiency lies, which means that's where you have the best chance of getting an advantage or having some sort of alpha that you can find. And a lot of that really happens through network, like particularly in our world, it's knowing a lot of different people, knowing the right companies to talk to, um, things kind of like that. So like it's like a high beta play on Bitcoin and has a bit of an illiquidity premium. And like that's kind of the thesis that we're working towards on the fund.
Love that. That's really interesting because like we I think a lot about the amazing time that we are currently witnessing with Bitcoin. I think it's extremely it's a massive gift that we kind of lived through this Bitcoin evolution so early on. That kind of Bitcoin happened within our lifetime, especially for everyone that is now like under 50 years old, or like maybe like under 50, like whatever the thing is. You will see you will see the pre-Bitcoin evolution and you see the Bitcoin evolution, and you kind of see how this all plays out in the very early stages. And I don't know about you, but like I feel like in hundreds of years, like they look back at like this time frame of like 2009 to like
Hmm.
2050 of like being um extremely revolutionary when it comes to finances and money in general because of Bitcoin. And I just feel so grateful and lucky to be in this time frame and to being able to document that and being able to like have companies in there and like being
Hmm.
kind of an active participant in there. It's like everything that we are doing in Bitcoin is like super exciting because of that. Like, oh shit, like people will look back as like,
Yeah.
oh yeah, there's like was this one podcast, like this thing, there's like this company, like I'm just super excited about that frame.
Yeah.
Thank you for watching this video. This was only a snippet of the podcast, and if you want to watch the full episode and get all of the context of this episode, you can click right here or here. Oh, maybe also here.